Introduction. Admission of a partner. Admission of a partner means reconstitution of a firm with the admission of new partner. On admission of a partner, old partnership is dissolved and a new partnership agreement is entered among all partners, existing or new. However, according to the provisions of the Indian Partnership Act 1932, a new partner shall not be admitted into a firm without the consent of all the partners. Let us discuss adjustments required on admission of a partner, change in profit-sharing ratio, treatment of goodwill, treatment of revaluation of assets and reassessment of liabilities, treatment of reserves and accumulated profits, preparation of partners, capital accounts and balance sheet, and adjustment of capital. Adjustments required on admission of a partner. Change in profit-sharing ratio, treatment of goodwill, treatment of profits or losses due to revaluation, treatment of reserves and accumulated profits or losses, adjustment of capital accounts, and preparation of balance sheet. Change in profit-sharing ratio. When a partner is admitted in the firm, old profit-sharing ratio of the existing partners changes because the new partner acquires share in profits from the old partners. The new partner may acquire share in profits from the old partners in one of the following forms: acquiring from all the old partners in their old profit-sharing ratio, acquiring from all the old partners in a particular ratio, and acquiring from some partners but not from all partners. Acquiring profit share from all partners in old profit-sharing ratio. When the new partner acquires shares in profits from all the old partners in old profit-sharing ratio, the old partners sacrifice their shares in profits. This reduces profit sharing of old partners by the profit-sharing ratio sacrificed by them. Therefore, profit-sharing ratio of old partners changes. This can be better understood with the help of an example. Acquiring profit share from all partners in a particular ratio. When the new partner acquires shares in profits from all the old partners in a particular profit-sharing ratio, the old partners sacrifice their shares in profits in the agreed profit-sharing ratio to the extent of share of profit of the new partner. This results in reduction of profit-sharing ratio of old partners. Therefore, profit-sharing ratio of old partners changes. This can be better understood with the help of an example. Acquiring profit share from some old partners. In case of the new partner acquiring share in profits from some of the old partners, the sacrificing partners sacrifice a specific fraction of their share of profit which is acquired by the new partner. This results in reduction of profit-sharing ratio of the sacrificing partners. Therefore, partner-sharing ratio of the concerned old partners changes. This can be better understood with the help of an example. Calculation of sacrificing ratio of old partners. Sometimes information about acquiring share in profits by new partner from old partners is not given, but information about old profit-sharing ratio of old partners and new profit-sharing ratio of all partners is given. In such a case, sacrificing ratio of old partners is calculated and new partner acquires share in profits in the sacrificing ratio of old partners. This can be better understood with the help of an example. Treatment of goodwill. The new partner pays value of goodwill in one of the following forms. Payment of amount of goodwill to old partners privately. Bringing amount of goodwill in the firm, in cash, in kind. AS 26 is an accounting standard issued by the Institute of Chartered Accountants of India, which deals with intangible assets including goodwill. According to AS 26, if goodwill is valued at the time of change in constitution of the firm, the goodwill should not be brought in books since it is inherent goodwill. If goodwill is valued, it should be adjusted through partners' capital accounts or current accounts. In case of admission of a partner, valuation of goodwill is required because the new partner shares profits and assets of the firm immediately, and he should pay for deriving this benefit. Treatment of goodwill is governed by AS 26. When new partner brings goodwill, this may be treated as total amount is retained in the firm. Part of the amount is retained in the firm and part of the amount is withdrawn by the old partner. Total amount is withdrawn by the old partner. Journal entries for the same are: retention of total amount of goodwill. When total amount of goodwill paid by the new partner is retained in the firm, two journal entries are passed. First, for receipt of amount of goodwill, and second, for appropriation of amount of goodwill to old partners' capital accounts in their sacrificing ratio. Let's understand with an example. When total amount of goodwill paid by the new partner is distributed among the old partners, two journal entries are passed. First, for receipt of amount of goodwill, and second, for distribution of amount of goodwill to old partners. Retention of partial amount of goodwill. When a part of total amount of goodwill is retained in the business, a part is withdrawn by the old partners, journal entries are passed for receipt of total amount of goodwill, distribution of part of amount to old partners, and retention of part of total amount of goodwill. Let's understand with an example. Bringing amount of goodwill in cash and kind. Let's understand with the help of an example. When new partner does not bring goodwill. If the new partner does not bring amount of goodwill, goodwill will not be recorded in the books. In this case, amount of goodwill is adjusted by crediting old partners' capital accounts in their sacrificing ratio and debiting current account of new partner by his share of goodwill, whether the capital is fixed or fluctuating. Adjustment entry for recording goodwill not brought by new partner is, let's see an example. When new partner brings partial amount of goodwill. When new partner brings only partial amount of goodwill, cash account is debited and premium for goodwill account is created by that amount. Amount which is not brought by the new partner is treated as new partner not bringing amount of goodwill, and his current account is debited by that amount. Journal entries will be. Let's understand with an example. Treatment of goodwill appearing in the books. As per AS 26, if goodwill appears in the books, it is written off by transferring it in old partners' capital accounts in their old profit-sharing ratio. adjustment entry is? Let's understand this with the help of an example. Hidden goodwill. Sometimes value of goodwill is not mentioned at the time of admission of a partner, though it exists in hidden form, also known as inferred goodwill. In this situation, value of goodwill is inferred based on capital contributions by partners and their profit-sharing ratio. Steps for calculating hidden goodwill are: calculate total capital of firm, calculate total adjusted capital of all partners, subtract total adjusted capital of all partners from total capital of the firm, and you will get hidden goodwill. Let's understand this with the help of an example. Revaluation of assets and reassessment of liabilities. In case of revaluation of assets and reassessment of liabilities, values of assets and liabilities are shown in the books either on revised values or pre-revised values. Showing assets and liabilities at revised values. When values of assets and liabilities are shown in the books at revised values, revaluation account is open for recording profit and loss arising from revaluation of assets and reassessment of liabilities. Format of revaluation account is as follows. Journal entries for the same are: showing assets and liabilities at pre-revised values. When assets and liabilities are shown at pre-revised values, revaluation account is not prepared. Instead, memorandum revaluation account is prepared. This account has two parts. First part of memorandum of revaluation account is exactly on the pattern of revaluation account, which is transferred to old partners' capital accounts in old profit-sharing ratio. In second part of this account, entries of first part are reversed. Balance of second part is transferred to capital accounts of all partners, including new partner. Let's understand with the help of an example. Treatment of reserves and accumulated profits. For adjusting reserves and accumulated profits among the old partners, these are transferred to old partners' capital accounts on the basis of old profit-sharing ratio. Journal entries for the same are: let's understand with the help of an example. Partners' capital account and balance sheet. Adjustment of various items is generally made in partners' capital accounts. Based on this information and other relevant information, balance sheet of a partnership firm is prepared. Format of partners' capital accounts assuming that A and B are old partners and C is a new partner is as follows. Let's understand with the help of an example. Adjustment of capital. On admission of a new partner, need for adjustment of partners' capitals arises when partners agree that their capital should be in proportion of their profit-sharing ratio in future profits. Adjustment in capital is made in the following forms. Adjusting old partners' capitals on the basis of new partners' capital. Determining new partners' capital on the basis of old partners' capitals. Adjusting old partners' capitals on the basis of new partners' capital. Steps for adjusting old partners' capital on the basis of new partners' capital are as follows. Calculate total capital of the firm. Calculate each old partner's new capital on the basis of his profit-sharing ratio. Calculate present capital of each old partner after incorporating adjustments. Calculate surplus or deficit capital of each old partner. Journal entries for the same are